Good morning, everybody. Happy Thursday. It's July 25th, 2024. Great to be with all of you today. My name is Bob Lang, and it's time for our daily bites. Getting started a little bit late today because I had to take a look at the economic data that came out this morning and give you a little bit of a heads up on this. So yesterday, boy, it was quite a day, wasn't it? It was quite a day with the markets down sharply. S&P 500 down better than 2%. Nasdaq down 3.5%. Not even the Russell 2000, which has been showing some strength in that index, the IWM, since July 11th, also got pasted as well too. Dow Industrials only down 500 points. On a percentage basis, it was much less than the prior to the S&P and the Nasdaq, but still shot across the bow for the bulls, right? Let's take a look at this chart here and see what I'm talking about here. The Nasdaq or the S&P 500 landed right on smack on the 50-day moving average. It gapped down and it saw no buying at all during the whole entire session. Let's take a look at that on the 5-minute bars. We gapped down and it just was red, 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 and all we saw was a sea of red all day long, right? Now, we've been talking about the potential for this happening all the way through, right? And so, you know what, we're not going to squawk and start taking victory laps over this, but the fact of the matter is that, you know, there's going to be pullbacks like this, right? And we don't really know the reason for it. We don't need to know why it's happening. We have to know what's happening and be able to shift gears and adapt to what's happening in front of you. Unless you want to stand there like a deer in the headlights, and when a car comes at you, you're gonna get mauled, right? Gonna run over. So what we recognized earlier in the week and last week, that this S&P 500 was struggling to get through that 20-day moving average. Now, that 20-day moving average is this dotted line here, right? It was struggling to get through there on a closing basis, right? We did get one close above there on Tuesday, but barely, on really poor volume as well too. But then, you know, we pulled back a little bit on, Monday, then on Tuesday, then on Wednesday we had this disaster. So not unprecedented. It was the biggest drop for the markets in close since late 2022. But one thing I was talking with Chris Versace about this morning, and he had suggested, will the S&P 500 get down to the 100-day moving average, and that's right over here, this gold line over here. Now, I share with you very good possibility of that happening, and I'll make a case for it. And Chris is you know, when he makes this observation, he's right on this one. Look what happened last time we fell hard from recent all-time highs, right over here, 5,200. We fell down sharply in April. We had a big down day here, similar to this. We had another big down day over here, similar to this, to these two over here, right? So this was signaling that we were, once we sliced through that 50-day moving average, which is the blue line, okay, we actually, the day before that, we landed right on the 50-day moving average and then knifed right through it and fell right to the 100-day moving average. But look at the similarities in the indicators below, right? So I want to show you, we had rolled over on the MACD and got to this negative level. We're not there yet. We had rolled over on the relative strength index up here, gently gliding down towards the 30%. We were not there yet. We're at 41%. But then take a look at this Chaikin money flow here, right? This is interesting. We were overbought in the Chaikin money flow for a long while the markets were rising up in late 2023 and early 2024, until this point when this market was going up, yet money flow was coming down. Look at this. Look at it. Money flow is coming down. Market's going up. That's called a negative divergence, right? So what ended up happening is we went negative at a certain point, and then all of a sudden people got religion in the markets and said, oh my goodness, we need to sell. We need to get out of here. And that's when this avalanche of selling hit. And we moved from about 5,200 all the way down to about 4,900, about a good 6 or 7% to the downside. What's happening now? Well, look at this. We had markets rising up here in the early part of July, right? and money flow starting to come down. Another divergence here, right? And now we've gone negative on the chicken money flow, much as we did over here. And we were once we went negative, we were negative in the money flow for about a good month here. So I see very similar patterns happening today as we saw back in April here now, right? Now, you might say to yourself, well, Bob, why didn't you catch it last week? Well, it started happening last week. We've had 5 down days out of the last 6, right? And normally what happens is that, selling begets selling. We get more selling happening, and you just have to protect yourself. And what we were doing all day yesterday in the chat room, and I was talking with people on social media as well too, and sending stuff out on StockTwits and Twitter or whatever. You got to have protection. I've been talking about protection for months, for years, okay? You got to have protection on. I think a lot of people out there are afraid to put protection on. Why is that? Because they feel like I'm just throwing money out the window. I'm going to lose money. Well, days like yesterday, you don't feel so bad having that insurance on. Now, mind you, it's not going to pay off every single time like it did yesterday. In fact, it may only pay off 2 out of 10 times, and you're going to lose money 8 out of the 10, right? But that's just the cost of insurance. That's the cost of lowering the volatility of your overall market exposure and portfolio, right? You've got to be able to be comfortable with that scenario, with losing small amounts of money, right, for the greater good. And the greater good is yesterday, if you had puts on, as we did going into the day and kept rolling them down, you protected yourself. I didn't have a very poor day. I started off poor, okay, but I kept adding more puts on yesterday, and it turned out to be a fairly benign day for me yesterday. Even though I do have some long positions, I did sell some of those, right, at losses. I sold some at wins, but for the most part, it was a rather benign day for my portfolios. And the reason why is because I have these constructed in a way where I'm going to skirt a lot of disasters like yesterday by having some protection on. So I urge all of you, not just have protection, raise cash, right? This is we're in a moment here in this market. Look at the chart again. Look at this chart here. Is this a market where you want to reach in and grab stocks? Not yet. You got to make sure that this low, is this low good? Is this low good? We don't know. We fell right through the support level of 54.50 yesterday and closed below it. And we're not even today making an attempt to get up there. It's climbing up a little bit here, but still, we're not even close to getting back up to that 54.50 level. So you've got to let the market prove itself and say, okay, that selling is over, and we can turn right back around. Again, remember something. We're not trying to catch a bottom. We're not trying to get out of the top. Tops and bottoms are a loser's game, right? If you're trying to catch the top or catch the bottom, you're going to lose most of the time. It's a loser's game. So wait and see if this bottom is good. If it's not good, then you got to wait and see. Maybe it's going to fill this gap down over here from back in June, 53.75. Okay, that's just another 1% down, right? And that would take us down, about 3.5%, 4% to the downside. So if we get that, and then we have another gap down here if we want to go even lower. I suspect though that after this big sharp move down in the oscillators. Now we talked about the oscillators last week, a week and a half ago. Actually, they were up at near record levels. The Nasdaq was up about 360 plus 360. It has come down in 6 sessions to a minus 17 from 360 all the way down. That is some heavy ass selling going on for the past 5-6 days. So what does it mean? It means that eventually selling is going to dry up, and it's going to be replaced by buying, and we're going to have one of those big whopper rallies. Now, we're not super oversold here right now on those oscillators, so that's the problem. It's going to be a slingshot rally, maybe one day into next week. It's setting up perfectly because we have a Fed meeting coming up Tuesday, Wednesday. We also have end of the month end of the month window dressing right now. I'll show you where the indices are at this point. We are minus 3.2% on the Nasdaq for the month. Lost basically all of the gains from, or we were flat coming into yesterday on the Nasdaq. Now we're down 3.2%. Russell 2000 is the strongest, of course, still up 7.39% even after dropping 2 yesterday. S&P 500 is now minus 0.5% for the month. For the week, it's down sharply. It was a big down day. Look at our portfolio. We were up 0.7%. How's that for relative strength, right? Relative performance. 0.78%. We were up. We're down slightly for the week. We're still up 22% versus the S&P up 13%. So that's a plug for the explosive option service. So getting back to the markets here for a minute. You've seen Apple is down a little bit. We see a little gain here in Amazon. We see IBM is up strong. They had good earnings last night. ServiceNow regaining some of the losses from the prior day. We're also seeing some strength in Chipotle. And then this morning, there's Chipotle there. Oh, now it's down a little bit. This morning, we had good, strong earnings from Raytheon Technology, RTX. That was up strong today. And then also AbbVie came out with some good numbers, although they're down off of that. Honeywell also getting slammed. That was it's down about $9-10. That's another Dow industrial stock. Tomorrow we'll have 3M, Charter Communications. Tonight after the close, we'll hear from Dexcom. And then 2 shoe retailers, Skechers and Deckers. Deckers, of course, does more than just shoes. And then Juniper is going to be coming out as well too. Tomorrow we'll have Centene as well. So still lots to work on. The next week, of course, is a huge week of technology earnings. I want to show you also another couple of charts here. And again, this is one that we look at quite a bit. This is the new highs, new lows. Breadth, always have to pay attention to the breadth, right? Breadth tells us a lot about where markets are at and where they're going, right? So breadth came in at plus 53. We had some really high readings last week, off the charts reading. And what we've noticed is that when we get these big readings, that's usually a sign of the markets topping or stalling out. And that happened about a week or week and a half ago, just before that, just after that CPI number came out. So coming back down over here to some more realistic levels, we're going to be watching this carefully. If we get into the negative numbers again, much like we were in April, look at these big numbers, big down numbers in April. If it starts trending in that direction, get some momentum to the downside in the breadth over here, we're going to get some more downside in the markets as well too. So pay attention to that. I think it's going to be it, everyone. Have a great day. Real quickly, before we go, I forgot to do this. What were the economic data looking like? Stronger GDP than expected, 2.8 versus expectations of 2. Price index a little bit lower than normal, so than expected, 2.3. But core PCE higher than expected, and durable goods for the month we're actually up a little bit over here, but we did get a down month in June, month over month, or the overall year over year core number on durable goods was better than expected. So what does it say? This says the economy is still humming along pretty strong. Inflation is improving. The Fed is going to be taking a look at these numbers very carefully as we go into next week's meeting. We also have an important personal consumption expenditures, PCE number, coming out tomorrow. The core number is going to be the key one there, right? We're going to be watching that very, very carefully. If it's hot, the Fed is going to acknowledge that. I think that the Fed funds futures market still now is ahead of where the Fed is at. I think the Fed is probably looking at 1, maybe 2 rate cuts in 2024. The Fed funds futures still at 2.5 rate cuts, way too far ahead of where the Fed is. So that needs to be dialed back a little bit. We're seeing a nice increase in fixed income today. TLT is up strong. So after yesterday's big sell-off in bonds, we're seeing some good strength in fixed income today. So we'll see if that continues. If that does continue, that'll be good for equities, especially small caps when rates are coming down. So that's going to be it, everyone. Have a great day. I appreciate all of you spending a little time with me today. I'll see you back on Monday morning. Of course, that'll be the last daily bites before the end of July. We'll be talking a little bit about the Fed meeting that's coming up, some of the earnings these last couple of days, and maybe any news that happens over the weekend. So again, have a great day. Have a great trading day today and tomorrow. And I'll see you guys all next week. Have a terrific weekend. And if you're in the chat room, I will see you there in a little bit. Thanks, everyone. Take care. Bye. We're standing in the shadow in the good girl. Her home with broken heart.